So I'll get us started. Right, welcome everyone and good afternoon. I'm really excited to be here with all of you and kick off the new year with the MES Toronto discussion group. My name is Claudia Mueller. I'm the Program Director for the Mining Academy, formerly known as the Center of Excellence in Mining Leadership, based at the Schulich School of Business at our Executive Education Center. We're really excited this season to support the discussion group with our technology and to be guiding you through the session today. So I will be in charge of the questions today and moderating the session.
Okay, thank you, Claudia. And thank you to your Schulich persona for supplying this technology for us. Welcome back, everybody. I'll say welcome back. We used to be physical, as you know, and we're in a new season where we have a new look through the Zoom. We have a new committee chair, Dave Robson, who will be organizing things for this coming season. As you may know, the past season got shortened unexpectedly. Like many other people had the same experience. Now we're planning to continue with our monthly meetings at the last Wednesday of each month, as we had before when we were physically meeting. The good news is that we now have extended our reach for both our attendees and our potential speakers for our Management and Economic Society discussion groups. This is the first one. We had a few minutes, a little extra time when you were in the waiting room there as we got things sorted out. And hopefully these will go more smoothly once we've seen how this stuff works and we've had a chance to drive it. It also gives us the opportunity, because of this extended reach, that we're going to be joining forces with other MES groups, and notably the Hong Kong group possibly, but the Vancouver group definitely, and the Montreal group, who will be holding sessions that will be available in the same manner. Probably not in our regular monthly thing, so there may be bonus ones for the people who are used to our last Wednesday of the month format. But stay tuned, and if you're on our mailing list, you will be receiving notices of those as well. So I don't want to take too much time away from Peter, but Peter Hall is one of our, well, probably our most consistent guest presenter. He's a popular season opener. We try to organize him to come and give us his view of the world and the mining industry in Canada from an economic point of view at the beginning of our season, which is September. And generally speaking, that's been what we've been able to do. We've had to reschedule a couple of times, and we've had some of his associates a couple of times. But we always appreciate Peter's point of view. He's got a vast experience of looking at all this stuff by his I think it was 25 years, Peter, with the EDC part of it, and longer than that in economics in general and government agencies. He advises internally on all kinds of economic input. I've observed over my limited exposure to economists that they like to model stuff and predict things, and they like to control one variable at a time. And then they like to introduce shocks to their models and see what happens when they tweak it this way or that way. And I guess all I'll say is that we've got lots of shocks and lots of variables working all at once this year. And so let's just let Peter take it over, and we'll see what he does with it all. Thanks so much, Peter. Take it away.
Thank you, Dennis. It's a great pleasure every year to be able to come back, and I'm sorry for those years that I wasn't able to make it, because we've always had a great time together as a group of people. It's usually the end of the day. Everybody's a little bit weary usually from our day of work, and I've never actually found that you haven't given me your full energy inside of these meetings, and so that's very kind of you to do that, and to welcome me back every year. I'm delighted to be able to have that privilege. Dennis, I'm just wondering if you could give me some kind of vocal signal that my slide deck is actually showing.
Yes, I see your title slide up here now.
Perfect. Okay. So what a task to actually sort of tie together all these moving parts that are happening at the moment. Dennis is absolutely right. You know, we love to get a model-based result as economists and then change a variable at a time and really sort of see what's happening. And you know, this is just a monstrous shock to a model, a monstrous shock to the economy, and it's sort of hard to know exactly where to start. If you think about a circular process, and you know, the economy is essentially a circular flow, you know, it's really hard to know what the intervention point is because it's pretty much a closed circle. It's hard to know exactly where to hit the economy. What I will say is, in addition, I'll say a lot of things today, but the next thing to say really is that you guys are getting a sneak peek on a forecast that we're not officially releasing until tomorrow morning. So you're not allowed to talk to anybody in the press in the hopes that, you know, of course, we'll get inundated with requests for them and will be plastered all over the media tomorrow. I always hope against hope that that will occur. We'll see what happens. But truly, at a time like this, very difficult to get all the pieces together and to come up with a cogent outlook. But of course, that's what we're paid to do, and we try to rise to the occasion. One thing that's clear amidst a very murky situation is that there's no living economist that's actually seen or studied anything quite like what we're going through at the moment. You might think, okay, well, there's always something hyperbolic to say about any event that comes along. And I'm with you. I really despise when hyperbole is overused to describe the mundane things that are going on inside of the economy. Not that necessarily we've had a mundane economy since the global financial crisis. We've had 10 very interesting years, 10 plus years of economic movement, and now this. Well, why is this one standing out in our view of history, not just in our view of recent history, but in our view of all history? Well, I'm not sure that we've ever had a moment in history where we have seen such a deep drop in such a very short period of time, followed by an outpouring of global response in terms of both fiscal and monetary policy. And so as we contemplate these gyrations of the economy and their magnitude, really, I haven't seen or studied personally anything like this, and I'm not sure anybody has. And so that makes it very difficult, of course, to do any kind of analysis, let alone forecasting, because we're sort of learning as we go, aren't we? We all are inside of our businesses. And that doesn't stop us, of course, because we all have a tool bucket of fundamentals that we appeal to. You have them in the mining industry, and of course we have them in economics. And I will say with a good measure of confidence that economic fundamentals still are at play. We can't lose it completely on the rules of operation and the logic that governs movements, even when they are shocked in a major way, as we've seen this year. It's just that one thing about our world at the moment that I need to point out is that the deluge of information that we all have to deal with, and there's way more of it than there ever was before, readily available and being created on a minutely and an hourly basis at a rate that we've never seen before. That's another historically unprecedented. And I think that what that does to us is it creates such a wide funnel of new information, and that new information pushes old information out, and we in the process have actually become quite myopic about things. There's so much to digest on a real-time basis that we're sort of forgetting about history. And I believe that we've done that for an entire economic cycle, quite unfortunately. And those of you who've been following the things that I've been saying, the audacious things I've been saying over the years, know that that's our frame of reference here. And so I'm not going to describe how we feel about the past cycle and how that's brought us to this particular moment in history. But I do believe that globalization has sort of stretched out the cycles and actually magnified the movements. So how do you then superimpose a pandemic onto a situation like that and make any sense of it? Well, the pandemic is something that in January of this year, nobody was anticipating. There was no data surrounding it out there. All the data that we have on it is brand new. So how are we supposed to absorb something that is brand new into our old ways of thinking and combine those things together and make some sense out of them? Well, the first point that I want to make right off the bat here in the presentation is, and I know you're very relieved that I've finally moved to slide number 1, is the pandemic data itself. It has supplanted all economic indicators, leading economic indicators, in terms of giving us a gauge of where things are going to go. It's become the predominant one here. And it isn't as if the other indicators aren't telling us something, but this is the definitive one. This is the one that, bar none, is going to tell us exactly where the economy is going to go in the very near term. Now, why is that? Well, when you see along here the rate of global infections that are rising, and the steep rise in that curve, and the country by country and region by region spread of this virus, of course, you then saw the reaction to that, which was some form of economic lockdown. Now, initially, when this curve was rising, of course, those lockdowns were very severe. They were very severe, and they were global in their reach. And so we're seeing the Q1 and the Q2 GDP numbers coming out. Q1 started to capture what was going on, but we really didn't see the full whammy until Q2 data came out. And of course, that was replicated right across the earnings spectrum, industry by industry. And then, of course, what does pandemic data do for us? When it starts to flatten out at the top, well, we know that the economy is coming back on again. The lockdowns start melting away, and of course, economic activity responds, and it's quite dramatic. Now, what everybody's worried about now is, well, what is facing us at the moment? With the Northern Hemisphere getting back to the schooling season, now we're seeing infection rates rise again, and everybody's going, oh my goodness, are we going back to March here where full lockdowns are going to happen again? Well, let's hope against hope that that doesn't occur, because we've spent lots of money to bridge the chasm between where we were and where we are now. And I'm not sure we've got much left to be able to re-stimulate the economy. I'm not the only one that feels that way. Everybody in industry, in government, individuals, public institutions or private institutions, researchers, everybody is hoping, financial markets lumped into that as well, that we're through this thing, and at least we don't have to go into another full-scale lockdown. But the pandemic data is going to tell us that, because if it does unfortunately start to rise again, we know we're going to go back into lockdown. So point number 1 here is, any strategizing that you are doing about mine development in a far-flung country, or your operations that exist there at this point in time, are going to be governed by the very country-specific pandemic data that we have. Now, the good thing is you don't have to call me up to get access to that, because one of the modern marvels is that something that wasn't even in existence at the beginning of this year very quickly became a real-time data experiment. So the numbers that are coming in at Johns Hopkins University are refreshed at least every 20 minutes, sometimes more than that. And that's about as real-time as a massive global data series can be at this point in time. It's state-of-the-art. Now, it's not just available to me, it's available to anybody who wants to go on that website. It's downloadable. You can get it by country, you can even get it by sub-regions in fully developed economies as well. So when you're actually looking at things and wondering where your business is going to go, you can do that at a very detailed level of activity. So that's point number 1. The pandemic is primordial, and the data that goes along with it is as well. It's fundamental to getting the economy right. All right, not every slide is going to be this long and drawn out, although the first 2 were. What is the real data actually saying to us? Well, here's a classic example of a V, and I didn't have to go and look in an obscure place to see a V-shaped recovery. This is data for Canada, as you can see, the US, and the Euro area. And what it's telling us is that retail sales in all 3 of those zones, which add up to roughly 50%, of global GDP, are now back to 100% of pre-COVID levels of activity. Some are beyond. And Canada seems to be doing better than the other 2. Well, What's the significance of this? First of all, retail sales are hugely important because they're a proxy for how the consumer is thinking in every economy, or at least in these economies. And if consumers are back to 100% in their thinking and in their retail spending here, that represents 60% of overall activity, GDP activity in Canada and the Euro area, and it represents 70% of American activity. Well, if we're selling into America, or if America is a large storehouse of demand for mining and mineral products around the world, then this is hugely significant in terms of how we're viewing the world. So a V-shaped recovery, 2 sharp months down. Look at the magnitudes that we're looking at here as well. You know, a 30% plus drop in Canada and a full recovery, you know, a 20% drop in each of the United States and Europe. My word, and we're back to 100%. That is remarkable by any description. So you might say, okay, well, cynics in the crowd are saying, you know, first question's coming up already. You know, Peter, thanks a lot for this, but you're missing the entire point here. You know, this is all stimulus. Well, actually, I don't believe it is. I respect the question, but hear me out on this. Prior to this, if we had had a pre-global financial crisis 2008 style bubble, which was anywhere from 5 to 7 years in the making, massive bubble, massive global bubble. If we had that this time around, then COVID-19 would have been the needle that came along and burst the bubble that already existed. What we actually had, folks, those of you who have been following me know exactly what I'm going to say here. We had an anti-bubble called pent-up demand in Western Europe and in the United States, not in Canada. We had a bubble in Canada, but we were unusual. We in Australia were perhaps unique in that respect, but there were no bubbles in these other 2 massive economic areas, engine economies of the world. And you can ask me about that in Q&A because for time reasons, I'm going to have to move on. But you know, when you look at housing, consumption, and business investment in both of those economic zones, significant pent-up demand. Now, what is pent-up demand? Well, it's the greatest guarantee that if the economy is going to have a big interruption like this, it has a very good chance of something like this, a V-shaped recovery. And that's what we see happening here. So this isn't all about stimulus. And in fact, I think it is largely about pent-up demand. But there's more to be said. You're going to get tired of me sitting on one particular chart here. This presentation will speed up, but I do need to make a couple of points in addition to what I've already said about this chart. And that is, during the V, we've actually had accumulations of additional pent-up demand. You might say, you're out of your mind, you know, there's no way that's possible here. You know, people were losing their jobs, demand was collapsing over this period of time, and you're absolutely right, those things were going on. But what about the people that were fortunate enough to continue drawing a paycheck over this period of time? There were millions of those, in fact, millions more of those that were operative here all around the world. Now, if you're still getting the same paycheck that you were getting before, and there's far less to spend on, what do you think is going to happen to that excess money? Well, it piles up inside of bank accounts, and central banks in the United States, Western Europe, and in Canada do calibrations on a monthly basis of what's actually growing inside of bank balances. And of course, the banks are forced to give that data to them. So it's verifiable data. And what they're showing is the accumulation of additional funds inside of bank accounts over this period of time. Well, that's overstating the case. They are a very significant percentage of accumulated life savings. Well, you can only imagine what that means in terms of a store of future firepower for the economy. And so if that's the case, then you've got that as a source of pent-up demand for when people feel like spending again. And by the way, they're not going to feel like fully spending until they feel like their feet are firmly back on terra firma. Alrighty. What's the second source of pent-up demand in here? Well, you might be getting a stimulus check from the government as a person. You might know somebody who's getting a stimulus check. You might know a business who's actually getting funds to tide them through this chasm. Are they going to spend all of that? Well, maybe. If they absolutely need to out of desperation, then they're going to spend all of that. But if they can, they're going to be hanging on to as much of that money as they possibly can, because they don't know when the doors are going to open again. They don't know when they're going to get their job back again, right? Persons and businesses both have decisions to make about that. Well, we believe that part of what's happening through this chasm period of time is people hanging on to stimulus money as well. And that's a store of pent-up demand for where we come out of this. Now, if I can make one more audacious statement about this chart is, we only got back to 100% of pre-existing levels. What happened to all the activity that was lost during the V? Well, the pent-up spending actually means that we could get another rush of activity on the end of this. Like when people are fully convinced that we are back, we've got another puff of activity that makes up for the chasm, the activity lost in the chasm when we were going through it. That's still a whole bunch of pent-up spending, and it still exists. Well, if you don't believe me up until this point, then let's take a look at official savings rates that are coming out of the national account systems of Canada, the United States, and Western Europe. What do you think they're doing at this time? Well, how do you spell explosion? Like, wow, look at this. This represents billions of dollars that have accumulated because people simply don't have enough to spend on. So they are spending on houses, they are spending on cars. I grant you that that activity is all going on right now, and they're still throwing billions of dollars into their bank accounts. That's a store of spending, as I've said, for the future. So proof positive that this is actually being counted, it is going on, and the consumer, as far as we can tell, is fundamentally in good shape. Well, suppose it is just the consumer. So 60% of half of the world's GDP actually doing well in terms of V-shape. Is there anything else that's experiencing a V-shaped forecast? Well, one wouldn't have expected that international trade would be experiencing the same thing, but actually it is. Same three zones, same V. Well, not exactly the same V, because we haven't closed the gap completely. But Canada here on the end of the series is actually at 94% of pre-COVID activity. So only down 6%, and it was down 33%. So a massive recovery going on here. Canada's ahead of everybody else, but Western Europe is not far behind, and the numbers coming out of Germany are very inspiring at the moment, you know, in terms of what's expected for the next 6 months, particularly in manufacturing. The United States a little bit behind. They didn't have a good May, but they're on the same trajectory. In fact, they're closing a bit of the gap with Europe right now. Okay, so even in exports, this is actually going on. Is it going on in all of exports though? This is just goods exports, and the answer is an unequivocal no. There are aspects of the economy, folks, that are not doing well. So I've made 2 points already. Number one, the pandemic data is primordial. Number two, you know, we do have a V-shaped forecast actually going on out there. But number three is illustrated almost perfectly by this data here. And it shows that the service side of the economy, the recovery there is not V-shaped, it's the dreaded L. It's gone down into the chasm and it's stayed there. Okay, so what do we mean by all of this? What is actually going on inside of the service industry? Well, tourism is down at the bottom. This is a 0 year for tourism, business tourism and personal tourism. There are other things that are in here as well. Business services are having a very hard time. What does that mean? Well, if you happen to be a software developer or a software company and you're selling internationally and you actually have to go and install a system into somebody's facility, if you have to go into all kinds of quarantine and so forth, and you're going to a dodgy country, or even if you're just afraid of travel and getting onto an airplane, you're saying no way. And a lot of them are. So you can't get services right now, trans-border services. You can't get service support. And this is probably as true in the mining sector as it is anywhere else. Because if you have mining services that you are doing, if you're doing geological services or some other kind of support for mining machinery or other aspects of running a mine or developing it, then there is a lot of trans-border worry, a fear factor that is keeping this from actually going on. Just imagine going to a place like South Africa at the moment, one of the worst pandemic affected places on the planet. Nobody's going to want to meet with you for quite a while if you're actually going there. So that just gives sort of a sense of what's going on inside of services. So a key point here is that you can have an average forecast out there of how things are going on. But it almost seems right now, from all that I've shown you up until this point, that you have extremes on either side of that. Well, what does that actually look like in real data? Well, here's the Canadian data for exports of goods. Now, exports of goods are back to 94% of pre-COVID levels of activity. And the same line is here. It's illustrated by the gray dashed line. So it's a different scale than the one you saw before, but that's 94% of pre-COVID levels of activity. And of course, it was a 33% decline, so a good recovery. But look at things that are on either side of that. I mean, you got food that's up here that almost seems to be having, you know, a banner year because of COVID. And then you've got things on the other side. You've got the aerospace sector, very tied to tourism. It's down in the chasm and having an awfully hard time actually coming out of it. Well, energy, which some around the table I'm sure are interested in, is even worse affected. And it has seen something of a comeback here, but in terms of where it was prior to COVID, it's the last industry on this chart. So in your own industry, we have some of this dispersion that's actually going on. So if you see exports of crude metals and minerals here, you know, it's right up there with food. Now, you know, that started back last fall, but by all accounts inside of these numbers here, whereas there have been ups and downs, you got nothing to complain about. You know, post-COVID, things have been, you know, easy cheesy here. But when you look at the fabricated metal side of things, well, if you're doing some processing of that, there's far less demand. So even inside of the mining industry and energy, you've got things that are all over the map. And so how does one actually move forward when COVID is doing this sort of extreme experience kind of experiment with all of us? Well, it is very difficult. We have to be very incisive about how it is that we actually move forward. So if this was our average overall forecast, and this is basically the pattern of the forecast that I'm going to be sharing with you, at some point in time, we actually get to pre-COVID levels of activity right across the economy with these very varied experiences coming into an average. And point D there is the point where we cross over. And inside of our forecast, it takes us into 2022 until we actually, in Canada here, get to that point, and many other economies are in the same predicament. The shape coming out of this is initially very sharp, going from A to B, but second wave infections slow the pace of getting back to normal from B to C, and then accumulated debts, public debts around the world, actually slow the rate of growth, so it keeps us from getting to that pre-pandemic level of activity, and then our permanent rate of growth is slower than it would otherwise have been because of the pileup of sovereign debt. Now, you may want to ask me questions about that when we get through this presentation here, but that's a key feature of the longer-term forecast. But this is the average forecast. Is it really meaningful when we get to the level of strategy? Well, no, it isn't. And that's where we get our K-shaped forecast. The upside of the K is the ones that are doing really well. And sorry, I'm sort of inundating you with alphabet soup here. I've given you a V, I've given you an L, I've given you a check mark. Now I'm giving you a K. What does this all mean? Well, the ones that are on the high side are on the upper part of the K. And of course, there's that dreaded lower part of the K. Well, who's actually there sectorally? Well, on the upper side, it's big tech, it's retail tech, telecom that has to support all of the tech that's actually going on. As I've told you before, the agri-food sector is there. You can throw in crude metals and minerals, and also the building supplies sector. We're all getting good at building decks and renovating our houses because we're tired of being in them and we can see all the flaws and so forth. So these are all the upside sectors. What about the ones that are in the basement right now? Well, I've spoken about travel already. Oil and gas is definitely down there. Aerospace is there, tied to the tourism sector. Old retail that won't actually move. The auto sector was there. It's actually bounced up into the high zone. So it's a real surprise inside of all of this. And then, of course, you got a lot that are in the middle. Well, when it comes to strategy, you know, we have to gauge what kind of impact are these different industries going to have on our demand set. I mean, there are some in the high sector that demand minerals. There are some in the low sector that demand minerals, either, you know, partially processed or fully processed. You know, their inputs into their systems and so forth. Well, you've got to be looking at these to decide where overall demand is going to go. So how are you fixed inside of each of these areas? And then, of course, there's the there's the business impact, but there's also go forward strategy. So how are each of these categories going to do in the longer term? And how do we actually change our business model to accommodate this situation? So that's how we at EDC are looking at things. Now, it's not just the sectors that are affected this way. As I've mentioned already, the K can be applied to different countries. Countries that went into this with very large debts. And if those debts happen to be denominated in foreign currency and held by foreigners, boy, they're in a lot of trouble right now, because they'll have to weather currency adjustments that might exacerbate their problems, and of course ratings agencies that come along and say, hey, you're not in the good books anymore, you're down there in the basement. So what are the countries that are actually there? Well, oil and gas producers, tourism focused and trade dependent. How about the ones that are in the top? Well, the countries that are less indebted, maybe they have a sovereign wealth fund, maybe they have some key growth sectors there. You've got to look at all of these things. And of course, EDC is here to help when it comes to that, because my own shop is responsible for analyzing up to 200 countries every year. And we make that available to you in our Country Risk Quarterly publication, which has 7 ratings per country, multiplied by the number of countries that we're actually analyzing in a given year. So it sounds like a tome. It's actually a very user-friendly tool that's interactive, and I encourage you to go to the edc.ca website to play around with that if you're looking at particular E&P plays around the world. And there you go. It's also by age and income, probably less relevant to this group of people. That's something that's more of a concern to final sales companies in the retail sector and so forth. But that's just another freebie that I throw in there for you. Okay, moving right along. Here is Canadian data that actually gives you a sense of how individual industries are doing. And this is in a GDP sense. Now, it's a bit more delayed. It takes about 60 days for this data to come out, which is an eternity when it comes, of course, to something like COVID. So this is a bit dated, but it's still very instructive for us, because you can look down industry by industry and say, how are we doing? Well, what do these horizontal lines actually mean? Let's go right to the top of the chart. The left-hand side is the extent to which this particular industry has been affected by COVID. So at the top here, we have retailing. And we can see that at the bottom, this industry was producing at about 70% of pre-COVID levels of activity. So that's what the left side of each of these industries actually means. The right side is the extent to which it's come back as a percentage of pre-COVID production. So retailing lost about 30%, and Zoom right along here, they've gained it all back, and they're over now 100% of pre-COVID levels of activity. Next one is the finance and insurance industry. So your banker or your insurance backer right now is actually doing quite well. Not much of a hit, and they're now back over 100% of pre-COVID levels of activity. So at least your banker is doing well, and your bank account is perhaps safe here, and maybe your access to funds is safe as a result of that. Beverages is next, big hit, and now back to over 100%. There are about 6 industries that are hovering around the 100% mark. Let's go down to the bottom here. Tourism occupies the basement. Big hit for accommodation and food, some recovery, but still at about 55% of pre-pandemic levels of activity. Carnage, second last on the list. Arts and entertainment, also a very tourism-focused industry. Massive hit, not much recovery. The auto sector, down to 9% of pre-COVID levels of activity. So a 91% drop in production here in Canada, and the most improved category, which at this reading was at 73%. We just got data today that shows us they're over 80%, and in fact, close to 90% back. So the most improved category out there, and a great user of minerals. So this should be good news for final end use. What about your industry in particular inside of Canada? Well, that's why I've colored these lines yellow, because it tends toward the lower end of things here. Now, I think that the newer data that we have out has actually graduated your industry higher. And energy still way down, but in terms of the metals side and the non-metals, doing decently in terms of recovery, hugging around the 80% mark. Not great, but certainly not as bad as those that are in the basement. Well, what you can also see here in the blue zone is that you've got every possible conceivable range of experience, industry by industry. I mean, this is just bizarre that, you know, right along this continuum, you've almost got an even distribution of experience from the worst to the best. You know, you've got the ones that are close to 100%, the ones that are close to the basement, and every range of experience in between. So the key point here, and I emphasize it again, is you have to be very incisive about strategy going forward and who you are selling to, because this is going to persist for quite some time. This is a key feature of our outlook. Confidence, notably, is back. So in terms of business investment, look at these business confidence numbers. Canadians are actually feeling pretty good about things going forward. But a warning here, this is the average. Some are uber confident about where things are going in the future, others not so. So again, when it comes to confidence, remember the K. Some are, some aren't, but on balance, we are back. All right, how about financial markets? Well, these are a key source of investment funds, let's say, for mining. How are they feeling about things right now? Well, if you can offer a good return, you can raise money on capital markets, in equities markets. You can borrow cheaply on bond markets. That's what these two charts are actually telling us at the moment. So liquidity provision inside of the marketplace, if you're a viable business, boy, you got lots of people that want to throw money at you right now. So dust off those figures, make sure that they're looking good, make sure you're on the right side of that K, and you can actually get good access to funds. Okay, we're getting down to the short strokes of this presentation right now. So a key one for you is, how are commodity prices actually doing? Well, they're not going anywhere in a hurry, in general speak here. So when it comes to the energy side of things, West Texas Intermediate is a great benchmark for that particular sector. From, you know, the mid 50s per barrel last year on average, we sunk down to negative pricing at the worst moments of the crisis, and are back up, but we expect to average just under $40 a barrel this year, creeping up to just above $40 a barrel next year. And of course, you can see Brent in there with the implied differentials. Not much movement in the differentials in either Brent or Western Canadian Select. Natural gas, sort of following the same routine. You can remember as well as I can the days not so long ago when natural gas was topping out at about $14 a TCF, now down at about $2, and not increasing by leaps and bounds as we go forward, but increasing. You know, the fundamentals are driving us that way. It's just a very modest climb. How about copper? Let's go down there. I'm going to skip over gold for the second. But copper doing reasonably well, hanging around about $6,000 per ton. And we do not expect that that's going to persist. Unfortunately, there's lots of global supply. It's going to take a while to actually bring it into throughput. Our 2022 prices are actually sinking. But for the next year or so, enjoy where prices are at. But for the moment, copper has lost its leading indicator status. Because when things come down, it will actually be a sign that the world economy is actually picking up steam as we go forward. Now, how about gold? Anybody interested in gold around the table? Well, I can't see hands going up, but I'm going to assume that that is the case. You might say, ooh, you know, you're hanging around $2,000 for 2021. We've seen it go above that. And, you know, you still think it's going to be there. Well, this is not a good comment on the global economy, because when gold is riding high, it's either because somebody is foreseeing a higher probability of a financial crisis, a fiscal crisis, inflation, or even deflation setting in. Gold is good for all of those categories, but it really is riding high right now, not because of fundamentals or scarcity around the world. It's really being driven by the fear factor. And we believe that that is going to persist into 2021 and then tail off after that. It has nothing to do with the base metal spectrum, although it's following the same basic profile. Gold is in sort of a precious metals island of its own, along with the other precious metals, and everything else is doing its own thing based on fundamentals. So I hope that's helpful for you. More than happy to answer questions about that as we go forward. So what is our currency and interest rate picture looking like? Well, let's pick on currencies. First, everybody's worried about the Canadian dollar. Where's that going to go? During the pandemic, people said, oh, expect 60 cents because we know that commodity prices are swooning. And there were others that were saying, no, Canada's in a better fiscal position than most other people, so maybe we'll attract capital because the future tax liability isn't going to be as high. Then we started spending our brains out. You know, maybe those people would have started weighing against the Canadian dollar. So why do we have such a boring flat forecast with all of that stuff going on? Well, initially I wouldn't have called for this, but our experience thus far is the Canadian dollar is maybe volatile, but pretty rigid around these averages. So what on earth is going on? We're a commodity currency. If commodities take a hit, the currency always does as well. So why are we seeing these non-movements in the Canadian currency? Well, it's because everybody else is depreciating at the same time. I mean, the US is taking a hit around the world in terms of the confidence that folk have in it because of their rising indebtedness, because of the political mayhem, the worries about how the election is going to turn out, and a number of other things, deglobalization being one of them as well, or the threat of it. And so when all currencies sort of move down together, what happens to their relative measures? Well, it doesn't look like anything is going on. And that's a danger inside of our marketplace at the moment, because you will see that extreme economies will have different experiences here. But the fact that the bulk of currencies are by and large moving in tandem with each other isn't a comforting comment on the world economy. It's actually quite the opposite. The interest rate profile sort of underlines that, because we're back to zero lower bound interest rates, and we're going to be there through at least the middle of 2023 as we see it at this point in time. And of course, that also presumes that there's going to be lots of quantitative easing going on over this period. So an expectation of an economy that's going to take a long time to get back to its full capacity position. We actually believe it's not going to take as long as central banks around the world seem to feel, but with the fear factor, their messaging right now is saying, look, we're going to do as much as we possibly can, and we're going to be in fear for as long as we're actually needed, because we're going to be here to support the economy. So the cost of funds, at least the official cost of funds, being very flat as we go forward. Well, how do we wrap this all up into a forecast? In a year in 2019 where some were saying, well, we're going to fall into recession, you know, it's 10, 11 years beyond the last one, so we must be due for it right now. You know, a rather average, a middling year of 2.9% growth. And that, of course, turned into an absolute carnage in the current year. And this number is pretty much baked in. We're beyond the halfway point of the year. Most of the data is actually in for the year. And if you want to contest me on the math of that, by all means, go for it. There are 7 quarters that go into determining the mid-year average for this year, and we've already got data on 5 of the 7. So not much movement unless, you know, the bottom drops out or we go to glory from now until the end of the year. It would take a phenomenal movement to really move us away from the figures that we're showing you now. But what is also extremely interesting about this number is that the appearance of fantastic, out of this world, unbelievable growth for next year is already baked into the recoveries that I've shown you in the charts that we've seen already. Those parts of the economy that are in V-shaped recovery are really pulling the rest of the economy forward and making these rates of growth for 2021 actually possible. And the general rule here is the harder you fell in 2020, the sharper you rebound in 2021. And by the way, if you think these numbers are extreme, they do not get us back to pre-pandemic levels of overall activity, even by the end of 2021. It's going to take us some time into 2022 to actually get to that point. Okay, great relief here. The presentation is coming to an end. What 5 key takeaways can I share with you here? Well, first of all, you know, I've taken pains to describe how uneven this recovery is going to be, both in terms of the path of growth, so initially very sharp and then flattening out as we go forward, so an uneven trajectory forward. Second of all, uneven with respect to different industries, different countries out there. So this is where the K-shaped forecast actually comes in. Second of all, pandemic. The pandemic is changing the way that we are going to work, but the pandemic data, as I've said before, is primordial. You need to keep your eyes on it. That's where the economy is going. There will be temporary impacts of that. There will also be permanent impacts of that. What are some of those permanent impacts? Well, business is talking about changing their supply chains. It's not something they're going to be able to do instantly, but they are changing their business models. They're talking about reshoring, nearshoring, and globalization. What does that all mean? Well, they're saying, look, basically, if we're selling into Western Europe, we want to design our supply chain sort of in the Western European zone. If it's North America, same deal. If it's Asia, well, we'll do the same there. We'll design our supply chain there. Pandemics, tsunamis, all kinds of different economic disturbances, the threats of, trade barriers and so forth, and the end of globalization. Look, we just can't do this anymore. We've got to regionalize what we do to minimize our supply chain risk. And so the locuses of business activity are likely to change somewhat. I don't believe the change is going to be fulsome, but I believe there's going to be a significant move there. Now, a related point is that a lot more activity is going to be virtual. There's going to be a lot more mechanization that happens. Nobody needs to teach the mining industry about mechanization. When people can sit in an office tower and run mining equipment hundreds of miles away with a joystick on their desks, which I believe is actually happening in some cases, maybe in a lot more cases than I actually know, well, that's a different kind of world. It's far less labor intensive, far more capital intensive, and much more intelligence intensive as well. And that's sort of the way the economy was going. The point about the post-pandemic economy is it's jolting everybody into a great leap forward with respect to the leveraging of technology that exists right now. So a key point, not just for the mining industry, but for all industries. Of course, we're all going to be operating more virtually as well. We're going to have to get used to doing things like this. And of course, there are great productivity gains that have come out of this as well that businesses are not going to want to let go of in the longer term. So expect more of this kind of activity to occur. And then finally, the costs, capacity constraints, and of course behavior mean that it's not all going to go away. We are going to be getting back onto airplanes, going to business conferences, trying to sell mining equipment or services or properties on the floors of trade shows around the world. Yes, PDAC, Mining Indaba, these kinds of events around the world are going to resume. In spite of the fact that PDAC was the place where Ontario had its first COVID case. Oh my goodness, I was there. You guys probably were as well. And nobody wanted to be around me for the next little while as a result of that. See what sacrifices I make for the mining industry. And we all do, of course, because it's a key one here in Canada. Anyway, enough of the attempt at bad humor here. I've come to the end of my presentation. I hope you have found these points useful. And I hope that, as usual, we can get into a rousing conversation about some of these things, because our views are not traditional views. They're not ones that everybody is saying out there, especially when it comes to pent-up demand inside of the economy. I'm very gratified, though, to see that there are some V-shaped things that are happening out there, because that's what we said was going to happen at the beginning of this debacle, and we're feeling very vindicated by that thus far. Nobody's welcoming accolades at this point in time, because the last chapter is nowhere near being written on this thing. We're going to have to tough our way through it. But I wish you all the very best. Thank you for being here. And let's get into a good conversation now. Oh, by the way, before I finish talking here, we got a lot of free stuff on our website that might be useful to you. And the first one on our list here, Country Risk Quarterly, I mentioned that to you. If you are looking at far-flung parts of the world and want to get instant Canadian-generated information on that, go onto our website, www.edc.ca, and you will find that information there. The global export forecast is what I just shared with you. Our materials are online as well. I write a weekly commentary every now and again. I dip into the mining sectors, so you might not find every issue of that useful, but certainly there. The last one on the list is an interesting one. It's Canada's Economic Recovery Tracker. This is something that we built for the pandemic, and we update that every 2 weeks. It's very real-time data that's actually in there, and it's far faster than anything else you'll find in officialdom. And so I invite you to use that as well. But I'm officially done now. So Dennis, let me pass the floor back to you. Thanks so much.
Thanks, Peter. I'm going to take over.
Oh, sorry about that, Claudia.
No worries, Peter. Thank you so much for that presentation. What an interesting presentation, and you know, what an interesting deep dive into some of the things that we are experiencing and have been experiencing for the last couple of months. We do have a couple of questions to get us going. Just before I start off with that, a reminder for everyone, if you do want to ask a question, just look at the bottom of your screen. You will see a Q&A chat. If you click on that, it will allow you to either type your own question or vote on other questions so that they will rise up on the list and I will be able to cover them off first. So I'm going to start off with the first question that we had that came up, and it's from Mike. And he asks, what's your take on the EV revolution and what it's going to do to metal prices, in particular nickel and cobalt, the battery metals?
Well, that's a fantastic question. Boy, when you look at EV production around the world, everybody's getting excited about the fact that Ford has just announced that they're going to be refurbishing Oakville to do 5 new models, all electric vehicles. And this is huge for Canada, you know, to attract this kind of activity. Well, it might be huge for Canada, but when you look at and I'm really excited about this, so I'm not gonna diss this at this point, but you know, it's sort of a drop in the bucket compared to what China is doing right now, because you know they're like, in terms of overall volumes, like nobody can touch them in terms of the massive amount of activity that is happening over there. It doesn't get talked about a whole lot, but the efforts that they're putting into this are already fueling price increases for the metals mentioned, and I don't see any end to that. Now, you know, in addition to the actual production of EVs and requirements that will likely be forthcoming on what we all need to do in terms of EV purchases right now, you know, we have technical development that is going to occur there as well. So Elon Musk is pushing very heavily on that at the moment, but there's this huge race for the next breakthrough in battery technology. Now, the crazy thing about that is if we vastly increase the efficiency of batteries, so that we don't have to have these big battery beds on the floor of the car there, then the actual use of sort of the lithium ion batteries that are being used or what have you at the moment might be reduced significantly. Now, you know, we don't presume any of those things are going to happen until they actually do. But the truth of the matter is that intense amounts of effort have been put into taking battery technology to the next level, because of course the gains for anybody that managed to do this are huge. It's sort of like inventing a new form of internal combustion engine. All of a sudden, all of the other ones are obsolete and you are a displacer inside of the marketplace. So when I, as an economist, see a market condition like this that says, man, if you could become a billionaire overnight by developing a process for a new battery that doesn't have, you know, 600 pounds of stuff underneath your car, but it's reduced to a much smaller box, everybody's going to go to that particular technology. You're going to become fabulously wealthy. Okay, time to get poor for a little while and go into the garage and invent this thing. You know, all kinds of people are all over the place trying to be the next battery-oriented Jeff Bezos. So, you know, it's in great flux. So if I was to draw straight lines around this, I would say absolutely. You know, all things being equal, if technology doesn't change, yes, my price forecast for these metals would be going through the roof at this point in time in about 5 years hence. But it's not, because we know what this dynamic is going to be. So we're standing back from that at the moment, not getting too exuberant about that because of this dynamic that's out there. That almost sounds like a too convenient answer for an economist here, but you know, that's the best I can give you of how these things actually work when you have the fundamentals that are in place right now. So I wouldn't, caution, or I would caution not to get too crazy about mine development in these areas because of those dynamics. But will demand be strong? Absolutely.
Interesting. Thank you very much. So the next question is from Sylvain, and the question is, how do you see trade wars or tariff wars impacting metal and mining companies?
Oh, again, an excellent question. You guys are going to be working hard to stump me today, but here's our take on this. You know, many would look at what's going on south of our border here and say, well, look, here's the place that has been a champion of free trade. This is a place, you know, that has been on the forefront of innovation, not just in terms of things like trade, but, you know, in terms of the nuts and bolts things that we do. And all of a sudden, this economy seems to be getting anti-competitive, very protectionist, acrimonious, you know, unwinding the institutions, the post-war institutions that have gotten us to the place that we're at right now. What on earth is actually going on? If the flag bearer has all of a sudden changed sides here, we're in a lot of trouble. What is the game plan? Well, you know, as hard as it is to maybe to telegraph what the US president, current president, is actually thinking on any given day, I do believe that there actually is a game plan. It's not all randomness and chaos. The United States, over a number of different administrations, has been livid about something that happened back in 2000. And that event was the accession of China into the World Trade Organization. Now, every nation that was admitted to the WTO up until that point had a very stringent list of hurdles that they had to get over. And of course, the tribunal there was very strict about the attainment and sustainability of those particular markers in each country, that they gave everybody a hard time before they got in. And the reason for that was to enforce the discipline post-accession. Well, everybody was so greedily trying to get a piece of Chinese business that they gave them, you know, buys on just, you know, a whole ton of things and lived to regret it. So America saw this tilted trade table and said, you know, we're just fed up to the teeth with this. Along comes Donald Trump and says, you know, I can roll my sleeves up and make this actually happen. And so how do you actually do that? Well, for a guy that wrote The Art of the Deal and, you know, sort of bullied his way through his billions by being a tough customer and really striking a hard bargain and getting great bargains all over the place, he said, well, I'm going to do the same thing for America. And so the bombast is really about getting a better deal. It's not about blowing the system up. And so that's been our view all the way through this, even at the toughest times of this. So, for example, I was down in Mexico in you know, early 2017. And, you know, the threats of walls going up and all of that had been an election thing. Now the guy was in office and he was, you know, increasing the bombast. And I was down there, made 4 presentations in 4 different cities. And I said, look, you know, he's not going to tear up the free trade agreement. It's too valuable to him. Made all my, you know, points about that. Got to the end of the week and, you know, what did he do? Well, you know, the border adjustment tax was imposed. And I went, oh my goodness, I've just told all of these Mexican people and Canadians that had invested down in Mexico that this wasn't going to happen. So I thought my job was on the line, you know, until at the end of the same day, the whole thing, that was torn up. You know, why? Well, it's because Americans have to pay for it, of course. You know, that sinks in. And, you know, how come you didn't wake up with that thought in your mind? Well, whatever, but it was gone. So I was vindicated by that flip-flop in a day. Now, it doesn't make people feel good that you have that kind of back and forth, but really this is about what's good for America, and what's good for America is free trade. So that's what I see inside of all of this. So that's why at this point, I'm not really bothering to figure out all of the mechanics about what the end of globalization would really mean for mining and for Canada in general, because I don't really think it's going to happen.
Interesting. Thank you. That was a great answer. All right, we're going to shift gears a little bit. I have 2 questions that are a little bit more looking at, I guess, you know, us as in consumers and the population as a broader group. So one question I actually have comes from Dennis. So Dennis asks if we can know if the savings explosion that you earlier on referred to is new money or just liquidation of assets that people are de-risking as part of their portfolios?
What kinds of assets are we talking about here? Can you help me out, Dennis? Maybe you've been locked out of the conversation.
I'm still here. I just didn't know if I could turn it on. Can you hear me?
Yeah.
Yep, loud and clear.
Okay. No, I was just thinking people are, some people are going ultra conservative on stock markets. Other people are just stop, you know, as you said, they stopped spending, but they might have stopped holding assets. They might have had something as an investment that wasn't stock, and they just decided to get out of that because it was a risky game.
Okay, great question, Dennis. I would, have to respectfully say that the net wealth data that we can see does not corroborate that that's actually going on. I think that this all happened so quickly and stock markets plunged so quickly that people didn't have time to get out. And while they were licking their wounds, of course, there was this phenomenal rebound in stock markets, and they sort of thought to themselves, okay, well, the herd mentality now goes the other way. I'm going to pile into a very good news story. And I think that's what's kept markets buoyant. They overdid it on the tech side of things, so there's a bit of a correction that happened there, but the markets are still quite buoyant. And so there really there hasn't been that sob story that would cause a liquidation there. If anything, there might be a liquidation on the bond side of things. The safe instruments are not doing very well at the moment, very low yields inside of those. And so many market calls are really for a bear market in bonds. But that together with quantitative easing is actually making a lot of liquidity available. And I believe, if anything, stock markets are being puffed up in a way that, might be sustainable for the next little while, because there's very little other direction that we can go in. So the answer, Dennis, is I don't believe that the savings phenomenon is related to a liquidation of assets at all. In fact, the opposite might be true. That those assets are actually going up and the savings are happening notwithstanding. Now, it is interesting that they're not taking those increased savings and necessarily putting them into investment instruments. The fact is they would still be counted as savings, and the usage of those savings, how people are parking them, is really up to them. Now, what we do know is that even though bank accounts are yielding very little at the moment, the central bank data are showing that there's a substantial increase in bank balance holdings. And I think that's primarily because if people have less to spend on and they're used to sort of managing their monthly flows, well, their bank accounts have gone up, whether they meant them to or not, because their paychecks are still being direct deposited into them. They just don't have enough to do with that money. So sadly, I think they probably haven't figured out what to do with these accumulated balances, or they just want to leave them around for a rainy day. But that's how I see that. It is true money. It's not artificial, not coming, well, I mean, it's artificial in the sense that it might be coming from stimulus, but it's not artificial in the sense that it's coming from liquidated holdings and everything, from any of the data that we can see right now. It's a great question, but that's my answer to it. I think the answer is really no.
Okay, thank you. Another question that is more focused on taxpayers. So how will the taxpayer money going to COVID support or going to COVID to support individuals and businesses affect sovereign debt, and how will that impinge on our long-term finances?
Boy, that's one of the more somber questions that that one could ask at this point, and it's an extremely good one, because everybody is focused on getting through this situation, bridging the chasm, keeping everybody whole. And in order to do that, well, that has been extremely expensive. So let's just try to put it in context. When Europe came together and the Maastricht deal was struck, there were two means that they used to make sure that no country would actually be a fiscal degenerate, because that would really cause fragmentation in the zone. So those two measures of sustainability were, number one, your debt to GDP ratio has to be 60%, or you have to be converging to 60%. And the second stipulation was that you could not run a deficit to GDP ratio greater than 3%. Okay, what's the difference between debt and deficit? Well, the debt is simply the accumulated deficits over time. So add all of those deficits up together and you essentially get the debt, and then you compare it to your overall GDP. So the deficit is a one-year miss on the budget. The debt is the accumulation of many years of budget deficits. All right, so those two measures are really the measuring stick for sustainability. So back in 2007, the US debt to GDP ratio was somewhere between 60 and 65%. Post-global financial crisis, it zoomed up to 105. So that was a shocker. And the hope, of course, was that when growth resumed, that number would come down, and it didn't. It stayed pretty flat over the intervening period of time. The US debt to GDP ratio now is expected to go up to somewhere around 120%, and outside estimates have it going up to 135. Well, that's the #1 economy in the world, the reserve currency of the rest of the world, that has now gone over thresholds that risk rating agencies used to say were well beyond the mark and would cause your AAA status to be downgraded significantly. Now, Canada had a particular experience of this back in the early 1990s, because we went in the late 1980s with a debt to GDP ratio somewhere between 60 and 65%. And when the recession was over, that zoomed up to close to 100%. The ratings agencies came out, sharpened their pencils, and threatened our economy to the point that the Conservative Party was obliterated. The Reform Party came up the middle, and the party that got us into the trouble in the first place was elected with a mandate to actually bring austerity to Canada. And they did it so well that Canada was exemplary coming out of all of this. Okay, I tell a long story because it's not an easy question. Let's bring it down to a close here. Every nation has now transgressed in terms of its debt to GDP. This is a scary situation. You do not have a nation that has not violated its own principles on thresholds of where its debt to GDP ratio would happen to be. So the sad news is we're all going to be paying for that all at the same time in either higher taxes or slashed spending or a combination of those two things. And that is actually going to limit growth as we come out of all of this. There's going to be a great crowding out of private activity because we're going to have to pay this back. Now, the good news is we're all going to be paying it back at the same time. So there isn't going to be a tilted table in terms of one country versus the next. But it does mean that overall global growth is far more constrained than it otherwise would have been. So that doesn't feel very good, but unfortunately that's the corner that we've painted ourselves into. Now, what is going to cause us to actually do that as we go forward? Well, again, it's going to be the ratings agencies. They're going to come out when we're through all of this and say, okay, now time to sharpen the pencils. Let's do an assessment of the situation. And boy, there's going to be a lot of black bolded headlines around the world about what this is actually going to mean for us, because we're blithely saying, okay, we just need to get to the end of this thing. We're not thinking about what it's going to cost us when we get out the other side of things. So anyway, that's our assessment of things. We've downgraded long-term growth everywhere as a result of all of this. And it doesn't make me feel good, not just about my kids and what they're going to have to be up against. This is going to hit us immediately. So it's going to affect you and I as much as it's going to affect them. So please let that be the last question, because that's sort of a somber note to leave ourselves on.
We do have a few more questions, and Mike would ask a question, says thank you, and he's looking forward to you hopefully giving a seminar on modern monetary theory sometime. So we have someone who's definitely very deeply interested in this topic. We'll move to the next question. So I do have 3 more questions that I think we can all answer. And one of them is about kind of where we're currently at in this pandemic. And then we have some more that are about the recovery or a second wave potentially. So we'll go in the timeline with that. So
Okay,
sorry, go ahead.
sorry, go ahead, please, please.
So we do have a number one question that has been voted on a couple of times. So we'll start with this one. So Rosemary asks, I would have thought that the drive to low carbon economy would have translated into more buoyant pricing for copper, considering how much copper is necessary for renewables. Did you consider government promise of implementation of green tech in your copper price forecast?
We actually do, yes. What we are doing is an assessment of the overall demand conditions, and those intensities are factored into the forecast that we had put together. So it's a super question. What we are looking at is the period where we experienced extraordinarily high pricing. So in the immediate period, let's say the 4-year period ahead of the global financial crisis, and then there was almost an equal period afterwards where prices were extraordinarily elevated. We were all under the belief, well, not all of us, but many were under the belief that we were running out of things. It was back to the old Club of Rome arguments that, there's only so much copper in the world, and there's only so much nickel and lead and zinc, and there's only so much oil and gas in the world. And so maybe we're back to that point. And that perception actually led to a reflating of commodity prices when the stimulus followed the global financial crisis, and it kept prices up there for quite some time. And of course, quantitative easing fed that as well. And we said that when the first round of quantitative easing was dialed down, and that happened in mid-2014, that commodity prices would come down with it. Bang on. I wish I had shorted markets to that particular moment, because I might not be here. I might be on some beach sipping exotic drinks somewhere. But the forecast call was bang on with respect to that. But what that led to was actually exploration and development that we're still trying to deal with at the moment. There's an overhang of supply because of these artificially high prices. And so we do have the throughput that's available to us to accommodate what's going on in the clean tech sector. And of course, we'll be inhibited there by the capacity on the clean tech side of things. So I'm not one of those that believes that energy, the pandemic has made, fossil fuels dead and gone forever. We still have energy intensities that when GDP comes back are still the rules that we have to operate by. We can't turn on a dime. As much as NGOs right now want us to be able to do that, we simply cannot do it. And of course, low fossil fuel pricing is a disincentive to that at this particular point. So people are saying, shoot, if I can get a barrel of oil for 35 bucks, well, I was planning on 55 bucks. So if production is coming back, I'm going to take advantage of that. And okay, targets are what they are, but you can't presume that people around the margin are not going to take advantage of these low prices. So, it will work itself out as we go forward, but we're trying to take all of these realities, crunch them together in a forecast and say, okay, here is now our best estimate of where prices are going to go based on all of that stuff. So an excellent question. Thank you for that one. That's how we answer it.
Thank you. Sorry, my dog just started barking in the background, so I had to mute myself for a second there.
I've got a dog that does exactly the same, Claudia.
Thank you. That makes me feel better. I guess most of us probably have some sort of animal around us that is making our days more interesting at the moment.
Exactly.
All right, we'll move into looking a little bit more at the future. So the next question is from Ian, and he wants to know what the impact of a possible second wave might be on the Canadian economy.
Well, we've done a downside scenario on that very thing, Ian, and we are concerned about that. And so we had the team vote on that downside scenario. By the way, this isn't just something that we do for a hobby. Every financial institution, because of IFRS 9 criteria, actually has to do, a base case forecast that's model driven, and then upside and downside forecasts. And our risk management office and our finance department actually have to approve these things. So there are 3 of us at a senior level that have to fully approve this. So I'm the third one in that triumvirate. And so these have to be officially blessed scenarios. So we put a lot of effort into generating them. And what we have as our downside scenario is a fairly severe reinfection rate that takes levels of output almost back to where they were in the trough of the first outbreak, and then a quick recovery from there, of course, because we still believe in this pent-up demand situation. So we've actually run that, and we've run a 25% probability through that. I didn't personally believe it was going to be that high, the probability, but there you go. This is a consensus vote, and we come up with something like that. So that's not just a non-zero probability. That's quite a significant probability of the downside. Really, this all comes down to the degree to which we govern a second wave outbreak well, and the degree to which the rest of the world governs it well. We're not in an island here in Canada. 64% of our GDP is trade. Now, you know, I already told you that 60% is consumption, so we've now got more than GDP. Remember that trade intensity is measured by exports plus imports as a share of GDP. So there's a bit of double counting that's going on there, but it's to give a sense of the intensity. And by the way, that's a generally accepted measure. Well, when you're that trade dependent, you know, the rest of the world's COVID experience really matters to you. And so here we are in quite a vulnerable situation. And yes, those downside numbers are quite ugly. What they would do to us then would be, we would not just have a negative in 2020, but we would have another negative in 2021 before we saw very sharp positives in 2022 and 2023 to pull us out of all of this. So that's a pretty severe downside scenario requiring a phenomenal amount of additional fiscal stimulus, which, as I've already said, we can't really afford. And that's a much different scenario to the base case forecast that we actually see. But at this point in time, you know, we do expect that a 25% likelihood of that situation is there. A development of a vaccine, of course, would do the exact opposite for us, would give us a high side scenario that is actually quite a bit brighter than our base case scenario is. So we actually give a 10% weight to that, and the balance, of course, is our base case. Great question.
Okay, very interesting. Thank you. So I have one more question for you before I turn over to Jesse for some closing remarks. So the last question, again, is moving on in the timeline, looking at recovery. You've earlier on already alluded to our neighbors and what's going on there also politically. And so the question refers to what recovery might look like under a Trump administration versus Biden administration. Do you think that one might be better than the other for the mining space?
Well, that's about all the time we have for questions today, folks. I mean, understand, I'm a quasi-civil servant, and so commenting on the politics of either Canada or another nation, I'm not really supposed to do, and you are recording this session, so that puts an additional constraint on me. I'm actually going to take a line on this that you might, based on those comments, find very cynical, that it's not really my true gut feeling about all of this, but I do want to look you in the eye and say, this is very much my core view on all of this. The United States has gotten themselves into enough of a debt situation right now that it doesn't matter who grabs the reins of power, they are going to have to go into some form of austerity. And in fact, I believe either side would have to go into the same form of austerity, because the gridlock inside of Congress, inside of the two bodies of legislation there, would actually force the hand of whatever president would happen to be there and say, look, this is the path forward, this is what you have to do. And if they wouldn't do it, then the agencies would force them to do it. So I don't think it's going to matter much. You know, you're hearing all kinds of things about the fiscal plans and what Biden is going to do versus what Trump would do. And there's quite a wide difference between those two different outcomes. I don't think any of that is deliverable. I think they're going to have to sharpen the pencils in pretty much a similar way, one versus the other. And if you like, over the past number of years, when it comes to austerity, the Democrats have done a better job than the Republicans. So that's what I think we're facing as we go forward. That doesn't make me feel good, because if that is the case, well, of course, that reinforces our thesis that growth is going to be weaker than it otherwise would be for the foreseeable future. But as I said before as well, Canada doesn't get unfairly punished as a result of that. The whole world is dealing with the same situation. So that's a great question to end things off with. So Claudia, thanks for moderating that. Pass it back to you.
Thank you, Peter, and thank you for answering all those questions, and sorry for putting you on the spot with some of the questions.
Not at all.
So that was great. Jesse, I know you had actually also posted a question, so I'll leave it up to you if you want to ask that yourself. We do have a couple of more minutes if we want to stick around, but I will thank Peter again for his presentation, and I will turn over to Jesse. Thank you.
Sure. I guess, yeah, thank you very much for hosting, Claudia. Yeah, my question, Peter, was what do you think, in your view, will be the new normal?
6.6. I'm just trying to answer quickly. That was not a serious answer. You know, I really believe in the pent-up demand argument. I just think it's the thing that nobody is keeping their eyes on. So if there's something that's going to offset the austerity, it's the fact that we never really recovered to begin with. And so the new normal is sort of very like the old normal as far as I'm concerned. You have competing elements that are actually going to keep us at what was really a substandard rate of growth in the entire global financial crisis, post-global financial crisis period of time. And so I don't think anything has really materially changed once we get out of this. And that's sort of a very bland story to tell. I wish, you know, I had something more inspiring to say, but certainly that's where things are at. Now, the good news is that that kind of activity is not setting us up for an imminent recession. You know, if we're still at sort of substandard levels of activity, then the good news is that, you know, there's not much that we can trip up over other than something like a pandemic or a natural disaster event. And typically we recover from them much more quickly than we do from a standard recession. So there we are. That's my 2 cents on that.
Well, thank you for the optimism. That's actually really encouraging news. I really like that answer. So yeah, I guess my closing remarks really is just that unfortunately David Robson, who is the new chair of the discussion group, can't be here to see us off. So I'm just going to announce the next event on his behalf. So the next event is actually off our regular schedule. So it's not the end of October as usual. It's going to be the middle of the month. It's Wednesday, October 14th, and the time is also slightly different just to better accommodate people in different time zones, and it's going to be at 3:30 Eastern. And our presenter next time will be Guy Desharnais, who's the Director of Mineral Resources Evaluation at Osisko Gold Royalty. And he's going to be presenting on tools to effectively evaluate and communicate the potential value of mineral projects. And yeah, so thank you again, Peter, and thanks to everyone for your patience and your excellent questions.
Thanks very much. Good luck to everybody.
Thank you. Bye.
Thank you.